So now we're gonna carry on this conversation, which we got to a great start with the keynote session, on how carbon is shaping mining, and in particularly how carbon is shaping energy for mines. And I think my original intro was very eloquent, so I'm gonna try to repeat that. So the chair of this session is an expert in this area. Michel Carreau is the director of hybrid power at Hatch. He's done projects with many mines, including Glencore, and now in Australia with South 32. He's got a PhD from MIT and a postdoctorate from Boston University with more than 30 years of experience in energy. He works directly with mining, ports, and industrial companies to develop solutions to reduce the cost of energy and lower their carbon footprint. And I know he's in the room, and we're on time. So welcome, Michel.
And thank you all for being here at the conference. We've got a great topic to cover in this session. And I'll introduce the first speaker, Emily Krebs, from the Head Investor Initiative North America Carbon Disclosure Project. Emily is leading the full range of investigator initiatives at CDP in North America, including advancing the global investor strategy, engagement with signatories and member, product development for CDP data in financial services industry and coalition initiatives, and embedded CDP investor relationships and expertise across a range of programmatic initiatives. So without further ado, here's Emily Krebs that will talk about how carbon is shaping the mining business.
Good morning, and thank you for having me here. I'm very excited to be here on a few levels. One is for those who are not familiar with CDP. We're formerly known as the Carbon Disclosure Project. We've been around for about 17 years. We're a nonprofit that focuses on global environmental reporting and disclosure from companies. And so just to give you an idea of what our reach is, we have reporting from over 6,000 companies globally across a variety of industries, including the mining sector. We have over 800 institutional investors who sign up to our disclosure platform requesting the information from companies. And then we have a cities and supply chain program as well, which I'm happy to get into at another time. So how we work is we use the authority from investor signatories, which means we ask investors to sign up to CDP, and we come to companies like yourselves, and we request environmental disclosure. We've been doing this since 2002. We then take the information that we receive from companies, and we feed it back to investors in the form of data. So we have about 15 years worth of environmental disclosure data from companies all across the globe, across many different industries. Now, what can we do with this data? I'll get to that in a sec. What we do with this data is we put it into investor research reports. And to be very clear, these are investor-focused reports, not investment reports. So I'm not here to talk to you about which company is good from an investment perspective. But we focus on high-emitting industries like autos, electric utilities, diversified chemicals, and then obviously diversified mining. And we're examining material climate issues. Carbon and water are the most relevant for us today. And we create a league table of companies where we can talk a little bit about how these companies are faring relative to others on some of these climate-related issues. One other thing that I just want to mention before we go forward is that our disclosure questionnaire evolves every year. And I'm sure there are people in this room who have responded to our questionnaire over the years and who continue to do so. But what we're trying to do as the industry evolves and as the financial markets evolve is make sure that our disclosure is aligned with the TCFD, which is the Task Force on Climate-Related Disclosure. And this was mentioned in the previous panel, but essentially this is saying, how do you look at your financial and operating reports, and how does that impact, and looking at your operations and climate change, and how do those two fit together? And for 2018, we're also going to have mining-specific questions because we think that there are topics that are relevant to your industry specifically that we need to make sure that we're drawing out and representing to investors in the best possible way. So going forward, looking at the TCFD framework, there are four 4 ways to align with this. We have transition and physical risks and opportunities. So transition risks, transition opportunities, physical risks, and physical opportunities. And we look at those 4 areas, and then we look at the potential financial impact, and we present that to investors. So looking at mining companies specifically, and where we see the risks and opportunities. We have seen reduction in costs, in emissions and energy intensity over the last 6 or 7 years. We do see 45% of capital expenditure coming from low carbon commodities, and this will in turn drive a low carbon economy, although we do still see 25% of CapEx being spent on fossil fuels. And I know that's a topic that is being addressed in these 2 days here. Additionally, and this I think is something that will continue to evolve in a discussion both from companies and the financial community, is that the carbon exposure in the value chains, so what are called Scope 3 carbon emissions, are somewhere between 10 times and 30 times higher than carbon emissions in the operational, so Scope 1 and Scope 2. And at CDP, one of the things we try to do is help companies quantify what that Scope 3 emissions look like and how that can be reduced to obviously benefit all of us with clean air and clean water, but also to meet things like the goals set by the Paris Agreement and such. The other portion of the risks and opportunities are the introduction of emissions trading schemes. Here in Canada, there's one certainly that's being explored. China recently announced that they're introducing one, and there are other countries that are looking at this that are key countries for the extractive sector. And then the final risk that many investors have not focused on to date is water stress, and how water stress and water conditions can impact the mining industry. So I won't go through this slide in detail, but essentially there are 20 different metrics that we looked at CDP to come up with what we call our league table across those transition risks, physical risks, transition opportunities, and then the climate and governance strategy. So here's a snapshot of our league table summary. Now, this has been prepared for the investor community just to help them understand how we look at each of these companies on those 4 metrics. Again, this is not an investment recommendation, and we are really thank all the companies that report to us because it's important for them to share this disclosure. So looking at the transitions risks section, here we're looking at emissions intensity, energy intensity, the value chain in Scope 3 that I talked about, the production costs, and then an EBITDA split by commodity. And as we go forward looking at disclosure from an environmental perspective for the mining sector, that split by commodity, both on the earnings side but also on the CapEx side, I think is going to become increasingly important. And I understand that CapEx plans for the mining industry are set several years in advance. And so the time to think about this really is now. So as we look at the mining emissions in the 12 companies 12 diversified miners that are in our report, a quarter of those emissions are covered by some type of carbon pricing scheme. And while just broadly speaking, outside of the mining industry, only about 13% of global GHG greenhouse gas emissions are covered by an ETS. In the case of the mining sector, that's actually much higher, and a lot of that is due to the regions in which many mining companies operate. And as I had mentioned earlier, the new and incoming carbon pricing schemes in China, in Canada, South Africa, Chile, and such, will continue to bring this to the forefront of investors' minds and financial market participants' minds as you look at financing using banks or underwriters as well. So just briefly on the commodity sensitivity to pricing, again, not expecting to go through any of these numbers in detail, but commodity sensitivity to carbon pricing is interesting because, for example, copper, the cost of emissions is very low in proportion to its value, and the lack of substitutes makes it equally attractive as a low carbon material. And this is in contrast to, for example, thermal coal and iron ore. And the bottom half of this, we're looking at some of the recent carbon pricing policies and where the dollars per ton, per CO2 ton is likely to fall. And as we talk to investors about these metrics, they start to understand that the potential internal price on carbon that companies use can be relatively helpful in terms of looking at some of the policy risk that is associated with their investments. So we talked about the miners cutting operational emissions intensity. We saw almost 9 out of 12 of the companies cutting emissions intensity, and 8 out of 12 cutting energy intensity over the last 6 or 7 years. And then a lot of these measures are also consistent with an industry cost-cutting drive that we've seen since 2013. So going back to the Scope 3 and China emissions trading systems, this really starts to highlight some of the value chain risk that we see for the industry. So for example, in China, this is now going to be 25% of the global mining the global extractives market is now going to be covered by the China ETS. And if one were to add just one more ETS or 2 more ETS in different countries, this could significantly raise that risk. Just going to skip over this. So going back to the point on EBITDA, one of the things that we are seeing that investors are recognizing as they look at climate risk with respect to the industry is that a lower proportion of earnings are coming from fossil fuel. And so on average, company earnings that in the low carbon transition have exceeded those from fossil fuels. And this is, I think, a trend that investors are pleased to see. And if, as people sit in meetings, they start to look and say, well, gosh, why is there such a prevalence of met coal or thermal coal in some of these earnings? And they're really looking to dig into these. So this is a chart that we show investors, and then based on this, they turn around and talk to the companies. And I'd encourage you to talk to some of your colleagues whose companies are represented here and ask them exactly how they interact with some of the financial market participants on this. So I mentioned water stress. And I know that this is an area with which you're all familiar, but the global water stress for mining is particularly acute because if we look at the company production split by geography, now this is the split based purely on the 12 companies that are in our report, you see a number of the countries, Brazil, Canada, Chile, South Africa, the US, where if you look at the chart on the left, you do see some high water stress issues already. So for example, in the Brazil and Chile region, we've seen some significant investments needed by Antofagasta for their desalination plant in order to be able to continue some of their mining operations. We've also seen the halt of mining development because of water scarcity issues, and we've seen lost production because of that as well. And I'm sure there are many stories that each of you have within your company's production where you could also point to potential climate-related issues, whether it was water stress, flooding, drought that really presented an unexpected challenge. And this is increasingly something that investors are looking for as they look for climate-related risks. So as we look to quantify water resiliency among the companies in our report, we look at asset exposure to water stress, the water withdrawal intensity, water recycled versus fresh surface water that's used, and then the water governance and policy. And for CDP, the governance and policy aspect is equally important to what is actually going on in current operations. So looking at baseline water stress, we expect over the next 15 years or so that's going to reach an all-time high with almost a third of production impacted by some form of water stress globally. So therefore, we're going to see an increase in the importance of water recycling. And I know that there's a lot of discussion here about R&D and new technologies and bringing that into place, but water recycling is definitely one area in which we've seen a fair amount of focus from the mining sector. So transition opportunities. Everybody talks about the risks, and they're like, okay, I'm tired of hearing about the risks. Let's hear about the upside. And as we heard on this morning's panel, electrification, batteries, electric vehicles, all of those will continue to drive commodity demand for materials that are related to the low carbon economy. So here's an estimate on how we see about a third of new car sales over the next 15 years coming from electric vehicles. And this is, I think, conservative to the number that someone threw out earlier about Elon Musk. And then as we look at the components for lithium-ion batteries, a lot of those are ones that people are focused on as they look at which metals and materials companies are extracting from the earth. So again, looking at the transition summaries, it's about CapEx split by commodity, the intensity of CapEx, capital flexibility, which I know is a challenge in the mining sector, research, development, and innovation, and renewable energy use. And so those are really a lot of the points that I think we're all here to talk about today, which is how are you incorporating renewable energy use? How are you looking at innovation, learning from different industries, and incorporating that into your sector? So we also do see more capital spent on low carbon metals than we do on fossil fuels. So this is going back to that breakdown of CapEx. Again, the first thing an investor is going to do when they look at this chart is say, I see some black on this. Why am I seeing that? And so having that discussion about that transition opportunity is incredibly important as you move forward and talk about your operations in a low carbon economy. There's also the reliance on fossil fuel energy sources. I think I'm probably preaching to the choir here. But the more we can see that transition to renewable energy sources, particularly distributed or off-grid renewable energy resources, I think the more the financial markets will give credit for that transition. Understanding that the upfront CapEx, you have to balance that upfront CapEx with the long-term potential penalty for continuing to use fossil fuels. So finally, climate governance and strategy. The areas that we look at here are the carbon regulation supportiveness, i.e. how much are companies embracing impending carbon regulation. Targets for emissions reductions, emissions verification, climate-related remuneration. I've got a slide on this that I'll touch on briefly. The use of an internal carbon price, and I think this is something that I know is particularly contentious within the mining industry, but with the introduction of emissions trading schemes is something that I think needs to be explored at all levels of operations. And then finally our CDP score. So looking at the internal carbon prices and executive remuneration. So the internal carbon prices, we ask a question in our disclosure about, do you have an internal price on carbon? What is it? Some companies give a range. So what you can see on the far left here is a very broad range of a carbon price from $5 a ton to $140 a ton. Now that can materially change a CapEx project, the earnings from a specific mine and such. So we recognize that, but we hope that these ranges will continue to narrow. For those of you who probably can't read the small print on this slide, but there are a number of companies that do say they use an internal price on carbon, but they haven't disclosed it to us. Others say, no, they don't use one, but they anticipate introducing one in the next 2 years. And then there are a few that say, no, we're just putting our head in the sand on the issue of carbon pricing. Now, climate-related remuneration. We've seen trends in the global corporate world for looking at executive compensation tied to profitability, tied to HR issues, and so on and so forth. But when we ask about climate-related remuneration, the maximum we have seen is 5%. So 5% of an executive compensation is based on whether or not they're using climate change governance as part of their overall strategy for managing a company. And so while the no evidence of climate remuneration is in the minority here, it's still a very small portion. And what we've seen is that when you start tying executive compensation to climate-related issues, that there suddenly seems to be more of an emphasis at the management level and at the board level in terms of the importance here. So finally, we ask about the aiming for A shareholder resolutions. And these are things that have come up in annual general shareholder meetings over the years. But we've asked if there are specific targets that companies have in terms of reducing, setting a carbon price, reducing emissions, and exploring those transition opportunities. Here are 4 examples that I did want to highlight. I know it's tough to read here, so I'd encourage you to go to our website to look at the report. But I think that these shareholder resolutions will become more and more frequent because investors take the information that we use, they take our investor research reports, and then they go and engage with companies. And so I would expect as over the next 18 to 24 months as we head into 2020 with the global stock take from the Paris Agreement, that you will start to hear more and more of these questions from investors in terms of what are you doing to further that low carbon transition. So that's all I have for today. Look forward to a discussion. And for those of you who don't disclose to CDP, I'm happy to talk with you later about that. For those of you who do, thank you. And we look forward to continuing to work with you. Thank you.